basically, I just want to take a quick walk through what's happened in the last month, because it's been a bit of an unpleasant turnaround. Although I don't think I don't think it's the beginning of a trend, and we should all be freaking out about it. And it's really mainly just been an issue with precious metals. Base metals have been a different story anyway. And I'll walk through what I basically think went on here. We all get pretty excited there late October, late August, early September. We ran up to the mid 1300s, and that was really a function of the market getting very negative about the US dollar. But I mean, really what was going on was you were seeing a big drop in nominal and real interest rates. Markets, the bond market had decided that the Fed was out of the picture for an extended period of time. As it turned out, Janet Yellen disabused everyone of that notion, as did most of the rest of the FOMC. They changed the tone of their speeches quite dramatically, actually, starting about 10 days into September. And you can see the impact here. There were a couple of other things that also created the issue. Really what happened here was that you had a real change in heart, because there's two functions and two things the Fed's got to do in the next little while. One is simply raising rates. The other is the great unwind of the QE, which they've been threatening for about 3 years now. And that's, and to my mind, what really changed things and what really woke up the bond market wasn't even so much the conversations about a rate rise in December. It was really her saying the FOMC is pretty much 100% in agreement. We're going to start rolling back QE starting next month. We're going to start buying bonds. We don't know specifically what impact that's going to have, because we don't know how many they're going to buy. I don't really see them coming in and making a mess of the market. They're not idiots, contrary to what some people might think. I'm not that concerned about it, but I think that seemed to take bond traders by surprise more than anything, really. And one thing I point out to readers all the time is when you're looking at short-term drivers of gold price, precious metal prices in particular, the important number and one you need to keep track of is real interest rates. It's not even so much nominal rates, it's real interest rates, which is basically the nominal rate minus the inflation rate. The chart you see here is something called the 5-year TIPS. It's a U.S. security. It's a Treasury inflation protected security. It's used pretty much by most bond traders in the market as a proxy for the real interest rate. You can see what happened there, and through August going into early September, how that rate dipped into the negative. It was about minus 10, minus 12 basis points. That's the sweet spot for precious metals particularly, but commodities in general. Negative real interest rates are basically the backdrop you want to have if you're trading commodities, because it's a very bullish backdrop for commodities. That rolled over, and quickly after these speeches started, the move accelerated after the Fed meeting in September, where they reiterated the fact that, one, they still plan to do another rate increase this year, and two, they're quite serious about starting to sell the bonds off their balance sheet this month. That's really, if you want to know what happened to the gold price, that chart is what happened to the gold price. Basically, real interest rates rising is an environment that's going to set most traders in the gold market. They're going to hit the sell button as soon as they see that, and that's basically what happened. The question is what happens from here. Basically, that's weird. Basically, that move to guarantee they were going to unwind QE is really what got the bond traders going. And what made the situation a little bit worse, ironically, the reason why the bond market didn't take Yellen very seriously, really, at all, earlier this year when it came to 3 or 4 rate increases, unwinding QE, is that inflation is the official signal. The FOMC, a big part of their job is supposed to be price stability, 2%. Inflation is their target. And the measure that they use is called the PCE, which is a personal consumption expenditure deflator, if you want to take the long name. You can see a chart of that here, and as you can see, it's kind of been falling off a cliff since early this year. It's basically going the wrong way, and this is why the bond market kept calling Yellen's bluff. Because if you look at this chart and you're a bond trader, you're going, there's no way she's going to raise rates. It makes no sense to do that. And I would argue that I'm not sure what her logic is completely, other than the fact she knows she's got to normalize rates before before the economy rolls her next time. She also knows she's probably not going to have her job in 6 months, so she's got no particular reason to be coy about this anymore. Whether the rest of the FOMC goes along with her, I don't know. But if you look at this combination of falling inflation, rising nominal yields, that's kind of the worst of both worlds. That did have an impact, as you can see here, on the dollar. The US dollar is what always gets blamed by gold bugs. You know, gold's down because the dollar's up, it's the anti-dollar, yada, yada, yada. There's two versions of the chart here. The one on the left is kind of a short-term version. That's the scary grown-up version of the dollar chart. The one on the right side is exactly the same chart, except instead of being 3 months, it's a year. You can see that looks considerably less scary. Yeah, there's a bounce, but it's not a particularly impressive bounce at this point. Strictly speaking, the downtrend hasn't ended. It appeared to me when we started this year that we were in a secular downturn for the currency, and the major currencies tend to have these 4 or 5 year cycles. And it looked to me like we were starting a downtrend, which is normally you're going to expect that to keep going for a couple of years. Notwithstanding whatever the Fed does or doesn't do, I'm not yet sold that we're actually out of the downtrend. I think there's real potential that we're still going to see the US dollar roll over and keep going lower. Normally when it does one of these runs, they don't end in 6 months. They usually go for a couple of years. And so far I'm not seeing any compelling evidence why this one should be any different than the last 10. You know, basically the market is now taking the Fed seriously. The other thing too is that because you've gone into this real risk on, you know, the Fed's serious, they're going to raise rates. If you look at the most recent pricing in the bond market, they went from about a 5% probability of a December rate increase to about a 70% in the space of about a week. That's when gold was really getting creamed. The question for us is, you know, what happens going forward? I mean, I think if you go back to that first chart there, that 2 year chart, and you look at the move in the last month, it's essentially priced in a 25 basis point move already. So I don't see any particular reason why those rates should keep running and running and running. We're going to have a weird month or two here because of the hurricanes. The macro numbers that are going to be coming out of the U.S. are going to be all over the map. These things have big impacts. They don't have big impacts long term. Hurricanes are actually good for business in the long term, strangely enough, because of all the rebuilding. But in the short term, things like employment numbers are going to be all over the place. So I don't think we're going to see evidence that's going to convince anybody things should move higher. I think we've probably seen most of the move, most of it's priced in. I also think that Wall Street right now in particular is pricing in a lot more legislative success than I would bet on personally. It seems to be taking as read on Wall Street that the tax package that they just started talking about in Washington this week is going to happen. I think that's far from being certain myself. They've got different enemies this time. It's actually the right wing of the GOP they need to worry about, not the left wing and the Democrats. But maybe they get the thing done this year, but I'm actually pretty skeptical. And that has also been priced in. So I can see 2 or 3 reasons why we should see things soften up a little bit. And who knows, maybe Yellen doesn't pull the trigger. A lot of guys I know in the gold market are convinced she isn't going to do it in December. I kind of think she will, and I'm going to work on that assumption. But I think we've probably seen most of the drop in the gold price. I don't think it's going to get a lot worse. And of course, the market's not just about gold. The sector is also about a lot of other metals and materials, and those have had quite a different move in the last little while. You know, basically what's happened in the last 3 or 4 months is you've seen a lot of traders gravitating to a relatively small number of situations. I don't think I need to tell you what they are, but I mean, you think Golden Triangle, you think West Pilbara in Australia, Novo. You're seeing a huge amount of money chasing a relatively small number of deals still. This is certainly not a rising tide lifts all boats sort of market, but that said, it's still actually pretty positive because there are in fact a lot of people that have made a lot of money trading in and out of those things, and that money to a large extent does tend to stay in the space. So I think it's a positive, and I personally don't have a big problem with the idea of more of a stock pickers market. I mean, some of the bigger area plays, if you will, you know, you got to be careful trading those if you don't know how area plays work. So I'm fine with this sort of concentrated money, but I think we'll see it spread out a bit going forward. And I think if you look at other metals, we've seen a pretty good pretty good market for some of this stuff. Now I'm showing you two metals, one of which I like, one of which I like less. Copper I'm fairly comfortable with. I mean, I did tell subscribers a month or two ago that it got ahead of itself. It's pulled back about 10-15%, but the market's relatively balanced right now. There are mines coming on stream. It's not a situation where I really expect to see copper taking off, but at 290 I'm quite happy with it. And that's definitely a high enough price to support companies and for companies to get a hearing and to get a good move if they put out good results. Nickel, I'm a little less comfortable with just because I don't understand where the stuff's coming from. The warehouse stocks really haven't come down that much. It's a metal that should do well, but it's a metal I'm not going to really be able to talk myself into until I see those warehouse stocks come off quite a bit. I don't think anybody in the nickel space, producers I'm talking here, is actually making money. So I don't think there's a lot of danger of a lot of new supply. The biggest thing you got to watch with nickel is Indonesia. There's still a lot of pig nickel coming out of that area. That's where most of the nickel supply comes from. That's the cheapest stuff. If the Indonesians let those guys keep producing, it's mainly mom and pops. It's mainly local operations. A lot of them got shut down. The Philippines stepped into the fore. But if that comes back on stream, then I'd be a little careful with the nickel space. There is one metal that I've talked about incessantly, I suppose, for the last year, and then I'm going to finish off with here, and that, of course, is zinc. And there's something that I sent out to readers a few days ago. The chart that you can't see on the right is basically a chart that shows the spread between the cash price and the 3-month futures price. For the last little while, zinc has been in extreme backwardation, and what that means in plain English is the cash price has been higher than the futures price, which is not how that's supposed to work, for reasons of carrying costs and such that I'm not going to waste my time on. Generally speaking, when you look at futures prices for anything in the futures market, you'll generally see an upward curve, and how steep the curve is based on interest rates. I'm not going to go through the theory with you, but the bottom line is the last little while, things have flipped over. The cash price has been significantly higher. Late last week, it was $60 or $70 higher per ton than the 3-month price, and that's a big spread. That's the biggest spread we've seen in probably 10 years. Normally when you see that, it's because there's a lot of pressure on the buy side. It's because you've got guys in the market that need to get long, that are willing to pay more than in a normal market they would, because they have to get their hands on the stuff. Some of those guys may be end users. I suspect some of them were guys that thought the zinc price had moved too much and were short. Right now, you're still seeing declining supplies. The big short-term question is, do we see Glencore show up? Because Glencore's got 500,000 tons per year in capacity they can bring on. They can't bring it on right away. It's important to understand that. It would take 6 to 12 months minimum, I think, for them to do it. So it's not really a short-term issue. The other is whether there's hidden supplies. There's official warehouse supplies for all these metals, and there's other stuff floating around. Nobody really knows what's out there. It's a very opaque market. So far, it hasn't shown up. But I told readers a few days ago, my expectation is we're going to see probably another fairly significant upward move. I think that started yesterday. We've seen the zinc price go up 67 cents in a couple of days. Everybody knew zinc was going to go up, so we're not seeing a lot of impact, although I'm starting to see it today in terms of trading of the companies that are zinc stories, one of which happens to be sitting next to me. But I think if it keeps going, and I think it might, I mean, this may be a situation where we see a 15 or 20 cent move fairly quickly. The current situation in the market, in the warehouses, is very reminiscent to me of 2007, and that's when the zinc price basically, I hope it doesn't do this, but that's when it almost went vertical in 2007, and basically went from about $1.40 to $2 a pound in the space of about a month. I don't want to see that. I'd like to see something a bit more rational, but there's not a lot coming on stream, so I think the potential for that to happen. I've said for a year that I think we're going to see $2 zinc. I don't think we're going to see it in a month, but I think it might be coming faster than anybody thought. So I would definitely be paying attention to zinc stories. I'm not even going to walk you through most of this because I just went through it, but essentially zinc's the one that's the strongest metal short term. I'm not concerned about gold or silver. I think they've probably found a base. We are in a bull market, though it seems like a stealth bull market for the sector as a whole. Companies that bring out good results will get rewarded. There's definitely been a tendency lately to favor high-grade stuff. One of the other companies in this section that's mine is a company that's drilling a very high-grade silver project that's never been drilled by anyone before. The market loves discovery stories. I love grade. That's part of the reason why I started following it. And I think developers that are lower quartile, ones that can put together a development scenario and say, we're going to be lowest quartile costs, or we're in a jurisdiction that doesn't have significant permitting risk where we can finance it. Those stories I still like a lot, and there's a lot of them on my list. I still expect we're going to see another wave of takeovers for most of those, though that may not come until the spring. But we're still in a good market that's going to reward these guys.